Welcome, my name is Todd with MoneyFit, and today we are talking about 7 debt consolidation options and the pros and their cons. We're going to go ahead and get right into it. Option number 1, the balance transfer, the credit card balance transfer. You could be getting offers in the mail and you're wondering, hey, this is a 0% balance transfer offer. It's got to be better than the interest that I'm paying on this loan over here. That can be one of course, the positives. Some of the negatives. Understand that there are still some situations where it can feel like a bait and switch. They'll send you a pre-approved or pre-qualified offer. And when you apply for it, you find that you don't qualify for that 0%, but that you qualify for a 12%. That's classic bait and switch. And regulators are not very happy when they do that, but it still happens from time to time. The great thing is also you have a single monthly payment to that new credit card. If you can qualify and you pay off all the other credit cards and debts, now you only have one monthly payment. And quite often it can be at a very nice 0% interest or other low promotional interest rate. However, here's probably the biggest downside to credit card consolidation or balance transfer offers. Within 1 to 2 years, about 70% of all consumers who use a balance transfer offer will run their original credit cards back up to their original levels. So now not only do they have the new credit card with all this debt on it that they've consolidated, those other credit cards that were zeroed out, they start to use them again because a balance transfer does not treat the cause, it only treats the symptom of the debt. If the debt came about because of overspending, consumer spending, transferring it to a new credit card is not going to solve the problem. It actually can make it double the problem. Okay, the next one that we're going to look at, option 2, is the debt management program, also known as a DMP. Debt management programs are what you would find them through nonprofit credit counseling agencies like MoneyFit. And the credit counseling agency will negotiate with your current creditors to lower their interest rates, which typically results in a lower monthly payment. FICO very, very clearly states there is no direct impact on your FICO score by participating in a debt management program. Now, the accounts do close. Any account you put on closes. And some people say, oh, that's a negative because now I can't use my credit card. Remember the point. You're trying to get out of debt. You're not trying to continue adding to your debt. Accounts close. That can have, anytime you close an account, it can have it may or may not, depends on your current situation, but it may have a negative impact initially on your credit rating. But over time, as you make payments and pay down your debts, typically your credit rating is going to turn out much better. All legitimate credit counseling agencies will work within the regulations that the states set, meaning there are capped enrollment fees, typically as of this recording in 2021, depending on your state, between $10 or so and maybe $100. And then there are monthly administrative fees, and these will, again, capped by every state, but they are typically they can be as little as a few dollars depending on how much debt you have or how many accounts you put on the program, but they typically max out at $50 or $75. That's debt management plan. Let's look at option number 3. Your HELOC, your home equity line of credit. This functions if you owe much less than what the home is worth, the difference is your home equity. That's the amount of the home value that you own, basically. And lenders, banks, credit unions, lenders will give you a line of credit or a loan, we'll talk about that in a moment, against that equity. The great thing is it's very flexible. A home equity line of credit, you can use it kind of like a credit card. You can make a purchase, pay some of it or all of it off. Some home equity lines of credit only require interest-only payments so that you never pay it off until the 10-year term or whatever it is when the whole balance comes due. Typically has lower interest rates than many credit cards because it's secured against the value of your home. If you don't make the payments, that's the downside. If you don't pay it on time or as agreed, there are typically if you don't pay it on time once, it's not going to be in default. But if you get 60 days or 90 days late, it becomes in default, and now they can put a lien against your home, so that if you ever do sell it, you legally that money from proceeds from the sale have to go to pay for that. So here's the problem with a home equity line of credit. Just like using a credit card balance transfer, if you use a home equity line of credit to pay off other debts, if you haven't treated the cause, you're only treating the symptoms by transferring the money to a home equity line of credit. Now you're likely going to run those credit cards back up. Plus, not only have the new debt, but that new debt is tied to your home. And there's a chance that you can lose your home, or you can have some serious consequences with your mortgage now that you've got some extra debt tied to your home. So that is number 3, home equity line of credit. Option number 4, this is your home equity loan. Again, if you owe less than what the value of your home is, that you can borrow money against that equity, that difference. A home equity loan, instead of like a line of credit where you can borrow some and pay some back and borrow some or not borrow any for a month or 2 months or a year or ever, a home equity loan is an upfront loan based on that equity. And you make set monthly payments every month. You make the same payment until it is paid off. Now, that's a great thing, because when you have a regular monthly bill, you know exactly how much it is. You know how much you're going to owe on that credit, on that line home equity loan. And you know that there's an end date to when it pays off. So that's a benefit. It also has a low interest rate. But just like the balance transfer and just like the HELOC, if you're not careful, you can run your other former credit cards right back up to where they were. So be very careful with both the HELOC and the home equity loan. Number 5, a debt consolidation loan. Debt consolidation loans are just what they sound like. You apply for a loan, personal loan or signature loan, and the lender gives you the money or sends the money directly to your creditors, your current debts, pays all those off. So now you only have a single loan to pay with. Sounds like a great idea. And having a single monthly payment can be very beneficial. Just like that debt management plan, you only have one monthly payment. The consolidation loan is really convenient to work with. Downsides. You are asking a lender to take on some pretty serious risk. If you're struggling to pay all these debts over here, and you ask the lender, oh, help me, give me a new loan so I can only have one payment. They're looking at all these debts that you might already be struggling with, and they have to ask themselves, do we want to take on that additional risk? If they're struggling already, why should we want to take on that risk? So when they do, quite often, it is at pretty high interest rates. Upper single digits, 8, 9% is pretty good. I pretty often see 10, 12, 14%, 15% consolidation loans. So be aware that you're going to have high interest rates. Now, those might still be less than a credit card. So in the end, it still might help. But keep this in mind, just like all the other debt consolidation options, you've got to treat the cause. Pay these all off with a home loan or a debt consolidation loan, but don't use them again. Close them. Don't get any more debt. Debt consolidation loans, there are quite a few people, and it depends on the study, but as few as 10%, 1 in 10, will actually end up with worse credit after taking out the loan. But your goal is to get out of debt, remember. Okay, option number 6. We're talking about the 401k loan, where if you have a 401k through your employer and you are still employed there, you can, depending on the terms of the plan and the rules, you might be able to borrow against that nest egg. You have to be an active employee, at that place of employment that is sponsoring that 401k. You can't get it from a 401k from a previous employer. The downside, it's going to affect your retirement. You're borrowing money, and while you have spent that money or paying off other debts, it is no longer building credit or building wealth for you, or building accruing interest or increasing its return for your future retirement. So it's definitely going to put a kink in your future retirement plans. It does have pretty low interest, which is great. There's no impact on your FICO score at all because it doesn't get reported to your credit bureaus. But if you lose your job or if you leave your job, your debt is due immediately, even if your plan allows it. Not all plans allow such loans, but be aware there are definite downsides to borrowing against your 401k. You're losing future profit from the investment, and there's a risk that if you lose or leave your job, the loan comes due immediately. And option 7, borrowing money from your life insurance policy. Sounds very similar to your 401k. It's only a possibility if you have whole or permanent life insurance. You can't get a loan against term life insurance. And the collateral that you're putting up for this loan is the actual death benefit. So that if you had taken out some money to borrow and something did happen to you, the death benefit will not pay out what you had expected it to, or what you had planned on it. So it's not taxable. Generally, that's a pretty good thing, and it does come with low interest. But you've got to repay it. You've got to repay it, and there's the risk that the whole point of having life insurance is to protect your dependents if something happened to you and your income. And if you're borrowing money against that, now there could be a potential problem should something happen. Okay, there you go. Those are the 7 options with some benefits and with some of the warnings that you need to be aware of if you're going to go that direction. Please do check out some other courses that we have, moneyfit.org/live. And we have an archive there of past webinars. My name is Todd Christensen, author of Everyday Money for Everyday People, Education Manager at MoneyFit. Thank you for joining me.